appreciate the kind words and the great introduction there, Danny. It's really good to be here. A really big fan of this initiative, and really thank you all for having me here. What I was hoping to do today is sort of walk through a brief presentation of sort of everything we've learned with regards to launching an enduring venture capital firm. I'm going to share a presentation on that. And then after we go through this presentation, I'd love to maybe jump into a brief kind of AMA with everybody about whatever concepts or whatever things that sort of come to mind here. So, you know, the topic that I want to talk about here is sort of what we kind of specialize at VC Lab, is to help launch these sort of enduring venture capital firms. Not really well suited to give advice on just like a one-off fund. Think of this like a talk about founders of VC firms, okay? And so what we're going to talk about today is kind of how to launch a firm, and what are some of the steps, what are some of the things that we sort of learned through our experience in the program. And really briefly on me, at this point, we're almost over 400 venture capital firms that we've launched. So I've helped like a lot of founders of VC firms get their funds off the ground. Prior to doing this at Founder Institute, I helped launch 13 funds as well. So I've sort of seen it kind of from all angles. And just from having managed all these cohorts, I've got a lot of experience with managing LPs and all the operations and things like that. And I'd love to sort of share that with you as well. Really briefly about the VC Lab Accelerator and how it works. And again, if you have questions about the accelerator, we can talk about it later. The topic of this is just, how to build an enduring VC firm. But, it's a program that's sort of no theory, right? It's 100% execution. And what it does is that it helps managers get to a closing very quickly. And we've built an entire supporting operating system that includes the entire tool set. So you don't have to put together a stack that's sort of jimmy rigged together with like a Zapier integration, the entire back office group, so you don't have to go out and hire a whole bunch of like service providers. And we also have a fund of funds that invests in the top performing managers. So sort of the whole kind of stack's been built to sort of support this accelerator experience. And just to maybe put it a different way, right now for new managers that are going out into the world, and raising capital, it typically takes an average of 18 to 24 months to sort of get to a first close. We've got this down. We're on cohort 13 now. And so we've been sort of iterating on this process over and over and over again. We've got it down to under 6 months from like an idea basically to a closing on a fund, because everything's sort of packaged together correctly. And again, happy to talk about this. This is not like a pitch for VC Lab, but I just wanted to kind of get you a sense of kind of what we've done. And, this is happening everywhere. This is like a total global audience, all sorts of different types of folks starting funds, all sorts of different types of communities. So it's not like, oh, well, it only works in my region or for my type of thing or whatever. It sort of has been designed to work across the entire world. Okay. So what I wanted to sort of talk about this is to kind of how to go from like zero to like an entire fund sort of off the ground. Okay. And so we're going to cover some of the main things here, main issues that we also see with new managers and emerging managers getting started, and then kind of go from there. Okay. And then once we get through this entire kind of agenda here, I want to sort of open it up and just have a kind of a discussion here once I've sort of kind of laid the foundation out. So when you first start a VC firm, you typically want to have some sort of a thesis, okay? The thesis is basically what you're going to do, how you're going to do it, and you want to get this down to be as concise as possible, right? Because this is what LPs, and for those of you that don't know, an LP is an investor that invests in a VC fund. This is what LPs are going to like gravitate towards and understand. And if this sort of one sentence thesis doesn't work with limited partners, okay, you're not going to be able to like raise a fund. It's going to be really hard for you to raise a fund, because if you can't get this stuff right, and if we're looking at just like this template that we've put together for you, These are all like, this is like your strategy, right? So you got like your fund name, the amount, okay, that you're going to be raising, the stage at which you're going to be investing in, where you're going to be investing in it, right? The country or city where you are, if there's a geography or a sector, right? And then most importantly, with secret sauce, like why you? Why can you sort of raise this fund? What is it about you that allows you to overperform versus the other hundreds of people that are going out sort of raising money? So you kind of have almost everything in this kind of statement here, right, that allows you to kind of build out an entire strategy in one sentence. And in the program, the way we know that the sort of sentence sort of works is that when you tell the sentence to 1 in 5 investors to invest in your fund, they typically sign or commit with the letter of intent that they're in. And people say, how's this possible? It's like only one sentence. Like, it doesn't make, it happens all the time. Okay. Because if you when you have like the perfect, when I always say this is sort of like the golden triangle, when you have the perfect GP, which is you, meets the perfect thesis, meets the perfect LP, okay, magic happens, right? And so that's why it's so critical to sort of start there. So let's take a look at what a bad thesis looks like, and I'll show you what a good thesis looks like. So, John's fund is launching a $100 million early stage fund. Okay, so first of all, $100 million for like a new or emerging manager, this is a lot of money, okay? Most limited partners are prevented by charter to invest in new and emerging managers because they're very risky. So the idea that you are going to raise $100 million, that means you need to get $10 million checks, $5 million checks. Those types of investors rarely invest in these types of funds. So it's super mistargeted, right? Like you're going to really struggle. Then early stage, there's no such thing as early stage. LPs have allocations for different types of investment classes. So is it pre-seed? Is it seed? Is it Series A? Okay, because an LP might already have a Series A fund that's focused on fintech, and you're now doing pre-seed and it's focused on fintech, right? So like where you're thinking about this. So it's like in Europe's like a very large continent, right? So with different languages, right, and different things. So it's like there's no sort of like focus here. To the fund companies that develop like SaaS tools, like I don't know, that's like that's like almost every kind of company in B2B sort of. And then like the secret sauce is like the passion for enterprise software. It's like there's like nothing here, right, that makes me believe that John's got is going to be able to sort of overperform on this fund here. So let's go look at a good thesis. Okay, so Acme Ventures launched a $10 million, very reasonable first fund, seed stage venture fund in Palo Alto. So we know that they're in Palo Alto, investing in AI, right? Leveraging the partner track record of 15 industry specific investments. So they've made some investments that are in AI. So we know that they're and they've performed pretty well in them, right? So like that's a pretty good secret sauce and everything together. So some people are like, well, what if I don't have a track record of angel investing or whatever the case may be? It's all good, right? Like you can say, I've advised companies that have done X. I've helped founders do whatever, right? So there's lots of ways you can sort of build this secret sauce. And we have a ton of what we call network leaders, people that are really well connected, do well and close funds. We've got people with very limited investment experience close and raise funds because this sort of secret sauce makes them, uniquely qualified to sort of overperform on this thesis. Okay. Without a good thesis, you have no foundation. You have no foundation for a firm. You have no foundation for a fund. And if you can't get this right, it doesn't make any sense. No extra materials, no pitch deck, none of that stuff is going to be useful at all. Okay. And if you can't condense it into sort of like a one sentence thesis, by definition, it's not focused enough. Okay. So just kind of some thoughts that we've learned here. So in the program itself, we spent like 4 weeks on this, and people are like, how do you guys spend 4 weeks on this? It's like, because, LPs need to sort of invest based on this sentence. Okay. Really quickly on fund size, I don't know who said this, but I forgot who it was, but it's like your fund size is your strategy is sort of a point here. And one of the biggest issues that we see in the program is that we have a lot of people come in with very unrealistic expectations about how big their fund size is. And again, when you're building a firm, your job is to get multiple funds under management. You can't just have one fund, right? Because if you just have one fund, you're going to be out of business, right? Because you're building a business here, right? And so like if it's just one fund, once you sort of deploy the capital, like what are you doing, right? And you're going to deploy most of your capital in like the first 2 or 3 years. So there's almost like no business there, and you might not be sufficiently motivated. So any like serious and LP is going to look, can this person have several funds under management? Okay. And so the reason I say is that it's okay for fund one to be small. And so what we end up having to deal with a lot in the VC Lab accelerator is that we have a lot of people with unrealistic expectations, right? Like I want to raise $30-40 million in fund one. And even though I've never managed money professionally before, or because I had a successful AngelList syndicate. AngelList doesn't count. It doesn't even really count for track record very well, right? Because it's like kind of semi-pro, right? And so a lot of these LPs are like, well, I don't know what I'm gonna, I don't know if I can use that in track record for my diligence, right? And so it just becomes an issue. So it's okay for fund one to be small. It's okay for it to be $5 million. It's okay for it to be less than $10 million. Think of it like like for the startups that some of you may back, or the folks here who have startup experience, oftentimes when you start a startup, you have this concept of an MVP, minimally viable product. With a fund, it's the same concept, minimally viable fund. That's your fund one, okay? You get fund one off the ground, you're no longer a new manager. So all that risk of you've never done this before, all that stuff sort of goes away in like fund two, which can now be 15, $20 million, $30 million, whatever it ends up being. And then after that, you're going to raise fund three in a year or two or later, right? And so I just want to make sure that I kind of hammer this home, that having a very small fund size is really helpful. Another way to sort of think of it is, who's going to fund you? Okay, who is going to fund you? Like, when you're raising money for a fund, this is not like raising money for a startup. You're basically going to these ultra wealthy individuals, and you're saying, hey, wealthy individual, let me manage your money for the next 15 years of your life to invest in these ultra risky companies, because I can do it better than you can, or I can do it better than your whatever other manager can, even though, I've never done this before, right? This is sort of like what the pitch is for new managers, okay? And so who's going to make that bet, right? It's going to be people that you know. It's going to be first degree connections, people that, it's not going to be some random person that you don't know, with the exception of someone like us, right, who has an entire fund of funds that specialize in backing new managers. Everybody's like scared as hell to invest in new managers, right? And so it's going to be like primarily like high net worth, like individuals that you know, and they're going to be the ones coming into like the first fund. And so the way you want to think about fund size is that, okay, if I was to go out and like ask all my friends and people that I know, how much can I seriously like circle? Okay, let's say that's like 500K or $1 million. Well, your fund should be like 2 or 3 times that, okay? Because it's possible that they're going to invite some of their friends and their friends of friends, right, in like future closings. And now you sort of have kind of like a fund and a fund size. I see there's a question here from Nate. You want to ask your question now? That's fine. If it's with regards to here, happy to do it.
Yeah, it is. Thanks, Mike. I have a question regarding the fund size. So does it change depending on the sector you're investing in? Sectors that have higher capital requirements versus others that don't?
Yeah. So no, the way you want to think, it's never driven by it's always driven primarily by like your ability to fundraise. And so what you're probably going to have to do initially, as you do go through this minimally viable fund size, and you go through this sort of exercise here, you raise what you can. Maybe you do smaller tickets to begin with in fund one. Fund two, you sort of build a little bit of a track record. Now, an institutional LPs have enough to sort of diligence to cut you a $2 million check or whatever the number is, right? And now you raise a bigger fund. Now your check sizes get bigger in fund 2, and in fund 3 they get even bigger. And so this is typically like, let's say deep tech's a good example of this, right? Deep tech funds, typically that's sort of the life cycle, and that's how they get to like $100 million fund 3 in like 5 years. You know what I mean? But all those funds are on top of each other, so you're sort of stacking management fees, so you can kind of build a firm now. So that's the typical sort of strategy. But it always, a lot of people kind of build this from like the investments that they want to make, and that's almost always a mistake. And this is how people end up undersubscribed. And so like, final thing, and I'll leave this on this. If you undersubscribe your fund, you're going to have fundraising risk for the rest of your life. Okay. So because every LP or every diligence thing that you're going to have to deal with in fund 2 is going to say, why didn't they subscribe what they said? So if you said that I have a $10 million target and you do really well and you get 9, which is, by the way, an epic achievement, right? Because you didn't get 10, every deal memo that every LP writes is going to say fundraising risk. And you're basically going to fight this uphill battle where all these people are going to wait and wait and wait to come in, right? So that's why what's better to do is just to set the fund size like 5 million or even 2.5 million, and then oversubscribe it. You could always oversubscribe, right? Because you can just write more tickets or whatever, or write bigger checks in the case of you, Nate. And oversubscribe it to 5 or oversubscribe it to 10, and then you don't have that risk. Okay. So just wanted to put that out there. The other thing that we sort of see a lot of folks kind of like mess up is that they basically don't focus on the right LP archetype. So I kind of gave you some examples of the type of LPs that generally you will like new and emerging managers typically tend to fail with. But look, if you don't focus on the right LP archetype, whenever you hear these stories of people having pitched 1,000 people to close, this is why. So they probably had too general of a thesis, which probably didn't make sense to a lot of LPs. They probably set their fund sizes like too high, and they probably focused on the wrong LPs. Okay. And so look, for pretty much most emerging managers, certainly in the first close, but most likely first, second, and even third close sometimes, they're going to be people in like your first or second degree network. Okay. So it's going to be one friend or someone that you work with, or boss, or someone that worked for you, that kind of thing. They're going to tell another friend as well, right? And that's sort of how you're going to get them. And they're pretty much always going to be like high net worth individuals. They're not going to be family offices. They're not going to be corporates. They're not going to be any of this stuff. Like they don't. That's too risky for them. Plus, they're going to hit you with like a 20-page due diligence kind of worksheet that you have to fill in, and you just can't fill it in, because you have like no track record and there's like nothing to fill in there, right? And so it's just like you're unable to even pass diligence even if you wanted to, okay? So what's going to happen is you're going to get sort of like these high net worth individuals. And, the most important part of all this is that it's going to be an emotional pitch, okay? They're not backing, like this spreadsheet, okay, of you being able to do whatever. They're backing, I don't know, Amy, right? Because of, your ability to sort of execute on this thesis, okay? That's what this is. And if they believe in the thesis and if they believe in Amy, they're going to invest, okay? So it's like a very sort of like emotional pitch. And that's how, like, I would say at least half of the first fund, arguably the entire first fund for a lot of people, gets done. Okay. So if you're sort of wasting cycles on like corporates, which can take like 2 years for you to close, and things like that, or institutionals, which you're going to really struggle with, you're going to probably still be fundraising in 24 months. Whereas the folks that are sort of targeting correctly are going to be moving on to fund 2, or if you're already on fund 2, fund 3 in that same period of time. And now you're way better positioned to do really well in diligence. Okay. Couple things on sort of like LP conversion tips. We talked a little bit about this. Look, until like 1 in 5 LPs say yes to your thesis, don't waste time on materials, don't waste time on other things, right? So we talked about this. We sort of talked about the LP archetype. I see a lot of people, we see a lot of pitches because, we have a fund of funds, and I do a lot of practice pitches with everybody. one of the things that I see a lot happening in these sort of conversations is I get slammed with like a deck, and I have to sit behind a deck for like kind of like you are dealing with right now for like 25 minutes. And that's not a pitch. A pitch is a conversation, right? Because they're basic, people are like sort of investing in people. And so most of you are going to be a lot better without a deck. Okay. So that's really, really important to kind of think about. We've developed this thing called a pact, and you can Google it. I can send a link later in the chat too. It's basically a way for you to hard circle LPs. So what's going to happen a lot is that LPs are going to tell you, I love you, I love you. This is the greatest thing I've ever seen. And they never give you anything. They never give you any money. And there's a term for it. It's called LP love. Okay. There's literally a term for it. And so what we've developed is a thing called a pact. Okay. Which is basically, think of it like a letter of intent. So you just send it to LPs and say, hey, great. As a next step, please sign this form to reserve your position in the fund. Okay. And what that does is that because they put their name on it, and it's non-binding, you don't have a fund yet, you don't have anything sort of set up or anything. It creates so much more like commitment from them. And so the conversion rate of these packs is in the 80+% range, right? So now all of a sudden, that those are people that you want to spend time with, whereas all these serial time wasters that are giving you LP love, waste of time. So don't spend any time with those folks, right? There's this concept of warehousing. So for those of the angels in the audience here, you move your angel investments into the fund at cost. So you're basically gifting 80% of your upside to the LPs, right? And that obviously gets people really excited if you have some really hot companies, because they get to be part of these companies right off the bat. And then, final thing here, just avoid shiny objects, okay? SPVs, okay? If you're going to go raise a fund, don't do any SPVs. This is a really bad use of time. Anything that tells you that they're going to introduce you to limited partners, anything, okay? You should be like red flag, red flag, red flag, red flag. Like none of this stuff works, right? Why? Because like I told you, it's like an emotional kind of commitment. So the idea that some random organization is going to be able to somehow match you with the right LP to come into your fund is just preposterous, and it doesn't work. And a lot of them are sort of illegal, by the way, because there's serious broker-dealer issues related to basically making investment introductions. And so like, just be very careful with that moving forward for everybody here. And so if anybody's sort of saying, hey, I'm going to introduce you to investors, it's not really going to work. Okay. And then finally, like salespeople. Okay. There's a lot of like fund admin folks, lawyers, whatever. They have very, very, very aggressive salespeople. Okay. And they sign people on like, and we're dealing with this a lot in the accelerator, where they're signing people on 3-year commitments to do their back office thing. And if you back out, you have to pay them 70 grand and that kind of stuff. And it's just like, it's really bad. Okay. Like Carta is notorious for this, for example. So if you're talking to a Carta salesperson right now, everyone, just stop. Okay, please just stop until you have 20% of the fund or 1 million plus committed in like pacts. Okay, do not talk to any salesperson, do not talk to anybody about like anything related to operations. Okay, this is again another huge time waster, because what you end up doing is spending all that time with those folks instead of you spending time with LPs. And so this is kind of what we've seen happen a lot. Like people sort of get distracted. And fundraising is a momentum game. So you sort of want to get as many people committed at the same time as possible. And so everything you're doing, every shiny object is a break in momentum, okay? Another thing is like every non-yes is a no. This is really hard for people, because like I said, LP love is real. It's like a huge issue right now in the industry. And so, if people are saying, I really like this, let me talk to my friend, that's a no, right? Like, let me just kind of like do some sort of analysis, that's a no. Okay. So just be very, very like deliberate about who you want to spend a lot of time with. Okay. Then you basically have 10%, and then you're able to close, and we can talk about sort of what closing process looks like. But if you sort of follow these sort of kind of end-to-end kind of processes here, now you're kind of coming into this like closing on your fund with like hard circled limited partners that actually care about you and your vision. You're able to open it, you're able to make sure that you hire the right type of providers and things like that to help you. And you've got the right strategy. So now all of a sudden you're really well set up for like fund one. You do a first close. Once you do a first close, you're no longer a person with a deck, but you're a person with a fund. So now you sort of de-risk it for all of the LPs who have come in and to introduce you to all their friends. And now all of a sudden you've got all of this momentum and you basically close out the fund. Now you get the fund one closed, and now you're in a really good position to sort of raise fund two and then fund three right off of that. Okay. So I'm going to just stop right here, everyone. If you have any questions about sort of like the closing process, about operating a fund, happy to sort of answer any questions that you have about anything. Okay. So I'm going to just stop sharing right here, and then we can get going with the conversation. Hopefully this was helpful for everyone.
Hi, Mike. I have a quick question. Could you talk more about warehousing?
Sure. So
Thank you.
warehousing means that you make an investment in a startup as an angel, and then you transfer that ownership into the fund at the price you paid for it as an angel. So let's say like 2 years ago, you invest in the company 25K at a 5 million pre. Hopefully that company's doing really well. So now it's maybe worth 50 million because they've raised the Series A or whatever, a seed round. So you move that into the fund, right, at basically a $5 million valuation. So then your LPs that are in the fund get this markup, right? And so the fund is already sort of in the money. And that makes it very appealing, right, for new investors. And it de-risks the fund quite a lot because you sort of already have some sort of traction with the fund. And obviously, you're gifting that. So you're doing them a lot of favors. Make sense?
Yeah, thank you. We've been using angel investments that we've made over the past couple of years, not so much as a leverage or warehousing them, but as just a showcase. So these are the types of companies that we typically would invest in. But I like that idea of warehousing. I think that language might be useful to some of the LPs that we've been talking with. But yeah, no, I appreciate that.
Well, the other thing you want to think about too is that you want to have a policy. Okay.
Yeah.
Like you can't like just cherry pick. Like you can't be like, I've made 5 investments, I'm going to put this one in. What
Right.
you want to do is you want to like, first of all, come up with this thesis like we talked about so that it's like, I'm investing in these kinds of companies, deep tech, blah, blah, blah. Okay. Then sort of look at all the portfolio that's sort of in that thing. Cause you also like, if you're going to warehouse, like this is your deep tech and you're doing some sort of real estate company or whatever, like
Right.
It just doesn't fit the thesis. So it messes up your story. And then be like, okay, I'm going to warehouse everything that I've invested in 6 months ago to now, versus just sort of cherry picking something.
Yeah.
Okay. Because that becomes kind of an issue for, as well to sort of deal with later, and you don't want that.
Yeah, no, that actually has been a problem because most of the companies that I've been an angel in, they do not fit our thesis. So it's not quite, I don't know if it would work to warehouse them exactly, but I think it's an interesting idea.
Yeah. Everyone that has done a lot of angel investments struggles with this in VC Lab. So it's all good. Just find the 2 or 3 companies that sort of fit and
Right.
build the thesis around that.
Gotcha. Thank you.
Lorraine?
Hi. Hey there. On that, just kind of double clicking on the warehousing. What if you have an SPV, you invested in a company as an angel, but in an SPV, can you warehouse your interest from that SPV, or is it just a direct investments are only, warehousing?
Yeah, you can transfer your interest, but there's an issue here that you sort of be aware of. Basically, what happens is that there's a venture capital exemption where, essentially, the way you want to think of it is like 80% of like the fund needs to be deployed into like startups basically that are ideally on thesis, you know. So VC funds can't really invest in SPVs, right? But you do have sort of this 20% exemption that gives you a little bit of flexibility there. So it would sort of count towards that. So the way you would do is you take that interest of yours, you transfer it, and it would sort of count as part of that 20% because it's not a direct investment. And so that's how you would sort of handle that moving forward. The other issue you sort of have with that though is, and it just says FYI from like forget the legal side and more like a practical side. Look, I mean, once you kind of become a professional money manager, you're going to have to be reporting, right? Every quarter, super legit style of reporting too, like not like here's an update on my companies with like balance sheets, income statements and stuff like that. And once you have that layer, right? Because you're in SPV, you don't really have contact with the founder. It's really hard for you to get valuation markups, and you're going to have to be updating those valuations at least once a year, probably every quarter. So it's hard, from a practical perspective, from a business perspective to do that. So you're almost better off like not dealing with the trouble there.
Yeah, that's what I thought. I just wanted to confirm that. Okay, thanks.
Of course. Amy?
So I've been on the StartOut demo day the last couple of years. I'm working with Founders Live to help co-host some of their pitches, but I haven't made an investment into any companies. Is that kind of a requirement or a precursor to starting a fund? Is that you've put your own money into, for other people's friends and family rounds beforehand, or can I build off of this experience that I have already?
So look, it definitely helps if you have a track record. That being said, we have a number of people that have closed funds without having made an investment before. Okay. But you have to have some sort of a edge, right? That allows you to sort of say, hey, because of this edge, that allows me to be a very, to overperform in this like sector or area. So I'll give you some examples to sort of maybe can help the rest of the audience as well too. We have a person, for example, who ran one of the biggest conferences in Turkey, and saw pretty much almost all the companies that, all the best companies in the regions basically pitch at this person's conference. So if you're sort of going to invest in that region, which is sort of a difficult region to invest in, especially as a foreign LP, investing through a person like this sort of makes sense because you can use the conference, use that, right? That filter. So that's one example. Another example of someone is there's a basically an kind of like what's called like almost like a free economic zone called Prospera. I think this is like in like Venezuela or something like this, where it's like basically it's like a place for startups to kind of go and like test stuff with like less regulations. Okay. And this person is sort of like the ecosystem leader for that entire kind of region and is sort of promoting it worldwide. And this person has done a very good job, like basically oversubscribing their fund, even though they've never, ever made an angel investment before, haven't had any experience at all, because he's sort of like the ecosystem, period, end of story, right? And so he just sort of is using this to kind of promote that. And he's targeting people correctly. So in his case, the kind of people that care about that kind of stuff, so largely like individuals, largely libertarian, right? And so like he has like the right kind of like LP market fit. And so he's able to just go and raise the fund and deploy it,
Thank you. I appreciate that.
No problem. RJ?
Hi. Sorry, I was a little bit late because I think I had the wrong Zoom link, so I hope you didn't talk about this earlier. But one of the things that I've noticed just with people sort of putting their name out there and establishing some sort of legitimacy that like they should even be building a fund, or people should be investing in their fund, is sort of going the route of like corporate sponsorship. So I just came from like a summit in Miami for Latin American fashion, and they actually did corporate partnerships to get like $10,000, $20,000 grants for like this sort of a pitch competition. And I was just kind of curious if you'd seen any sort of experience with going that route to sort of, I guess, build the connections, establish some legitimacy of like, we know how to pick companies and we put money in there. And now we're sort of looking for investors to, as opposed to giving grants, making investments in the company. I don't know. I'm just kind of curious what your thoughts are on that kind of approach to starting the journey of building your fund.
So the way you want to think of it is on a high level, venture capital is a network business. That's what it is. If you don't have a big network, and this is what we look for in admissions too, like if you don't have a big network, it's really hard for you to succeed, because like a good, like forget the enduring VCs. The enduring VC is like the Sequoias. They're seeing 10,000 companies a month. Okay. Obviously you're not at that level, but like even like a new manager sees 500-ish a month, right? Or, like if they're kind of have the right profile. And that's just deal flow, let alone all the stuff we talked about with regards to raising the fund, which, like I said, is going to be from people that sort of know RJ and trust RJ, and they're making this missionary bet on RJ. So if you don't sort of have like a network, you're just going to struggle to fundraise, and we have a very clear correlation at this point. So we like that really factors into sort of our admissions criteria, right? So you building the network and becoming sort of like the network leader is absolutely critical. If you don't have that now, I would just focus on that now. And so what I would do though, if you sort of want to hack this and make it fast, right, faster, is try to sort of find your edge and your niche. So remember when I talked about in the thesis presentation about like the secret sauce? A lot of people sort of struggle with this. It's like, what is it about RJ that sort of allows RJ to perform well on this thesis? And then you can sort of like, you can start building that network by hosting events, by, attending those events, by getting on panels. Everyone needs a panel on this specific thing. So I'm just making this up. Let's say you're doing an insurtech fund. You can become like the insurance like expert by doing this, and you can get there pretty fast, right? Because there's just not a lot, and it's pretty blue ocean, and that's how you would do it. Okay. To build out your network. That being said, everyone, I'm going to put a link here in the chat here. Be super careful with what's called general solicitation. Like you can't go out in public and say, hey, I'm raising a VC fund. Okay. This is illegal. It's got some pretty serious consequences. So you can't be going out like, hey, I'm raising a VC fund, blah, 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 blah. Like, okay. So I put up a link on sort of how to stay away from the general solicitation issues. But, and if you have more questions, of course, I'm happy to cover it. The other thing too, it doesn't look good. Right? Like if you put up a landing page with like a invest here button, it looks sort of cheesy, right? It's like you're like an exclusive offering that's sort of available to a subset of people. So it just doesn't even work very well, even if you wanted to do it. So did that answer your question, RJ?
I think that's super helpful. The funny thing about going to the summit, and it's like there are a lot of high net worth individuals that were at the summit, but for some reason, the approach is to give grants rather than to make investments. And so it's sort of like a paradigm shift of like, we could have Google give us 20K to give to a company, but how do we? So that's sort of kind of what I'm wrapping my head around, but that's super helpful. Thank you.
Yeah, and everyone that sort of has any sort of like impact related thesis or like diversity related thesis or anything like this sort of like runs into this issue. But the thing is that you can't have impact without performance. It just doesn't work like that. And so a lot of the stuff that's happening with grants, a lot of the initiatives, okay, even some of the LPs that are like, they want to sort of back diversity, because they want to sort of like back diversity, they're not like necessarily like picking for performance as much. And then that creates like sort of like this vicious cycle that doesn't really work, right? And so the way you can fix that is by sort of having the donors kind of understand that most of the impact comes from performance, right? If you find that founder or that company, whatever the thing is, and that company becomes very large and its scale and the amount of jobs and whatever it's doing, that's what's sort of going to fix the world's problems, versus like saying, I'm going to back a whole bunch of managers that care about ESG, right? Or about a bunch of companies or a bunch of founders that are care about ESG, because then you're just not going to get returns. And therefore, they're not going to build good companies. They're going to probably fail. So who cares? Does that make sense? So just like
That's super
try to always
helpful.
marry performance with that.
That's super helpful. Yeah, because it was surprising at times too. Like these aren't like small businesses. They're medium-sized businesses, like $50 million annual recurring revenue. And I'm like, what we really need to talk about is investment here, not like the visibility and of the prize or whatever is great. But anyways, thank you. That's helpful.
Sure. By the way, everybody, if you don't want to unmute, you can also add a question in the chat. I'm happy to answer questions that come in the chat as well.
I'd also say, Mike, if you want to reshare your contact info either on the screen or if you want to drop it in the chat, if people want to follow up. And then Long, if you're on the call, if you want to include anything for VC Lab, it'd be great to be able to share those resources for folks as well.
Sure. I will say that, if you're thinking about starting a firm or working on a firm right now, the program's pretty good. Happy to answer questions on that too. But I'm going to put the link in here. Our final admissions end on November 20th for cohort 13. And you're going to close basically in Q1 with this program. If you're not ready, we do a program every quarter. So just wanted to put that out there. You can learn more. There's also a whole bunch of like super helpful resources, because what's happening right now in the industry is that most of the stuff you read online is just not good, right? Because it's basically written by, people with like less experience, and it doesn't go into a lot of detail. So we sort of have built this out kind of for you on our blog, as well as in our tool system.